Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education at Schwab, and this is Getting Started with Options. And today we're going to be talking about an essential element of options trading, and that is really understanding how time impacts the performance of an options trade. Whether we're buying or we're selling, time can ultimately play a vital role in the outcome of a trade. So a trader might want to understand how time really works. It's one of the more predictable elements of options trading, but there are still some nuances to it that we really want to understand. So I'm looking forward to some tools on Thinkorswim that are going to help us understand time and how we might use it to gauge whether we're buying or selling options. A lot to discuss. Before we can get into any of that, though, let me first of all say hello to everybody that's joining us out there in YouTube. Hello there, Will and Ricebird. We have Troy, Ranjit, Rosa, Janelle, Life in the Fast Lane, Eva, everybody else. Thanks for joining us week after week. We really do always appreciate your attendance and your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the fact, if you're just watching the recording of this presentation, enjoy the show, but be aware that you're invited to join us in the live discussion. This is a Tuesday webcast series, and we kick this one off promptly at noon Eastern time. If you'd like to join us, we'd love to have you here in the live audience. And also, our live audience members should know that my very good friend Kevin Horner is going to be hanging out in the chats. Kevin's going to be addressing any questions that I can't get to just during the flow of the presentation, as long as they are on topic. Kevin's going to be there to help pick up the slack for me. So thanks for being there, Kevin. And Kevin and I would also like to issue an invitation to everybody watching, whether you're watching live or you're on the archive. If you have an account with X, that platform, make sure that you're following your favorite presenters there. You can follow Kevin on X at Kevin Horner CS, and you can find me there at Cameron May CS. But let's get into this discussion. Of course, as we do, we need to first of all pause to consider the risks associated with trading. Trading risks absolutely apply to options trading, so bear these important disclosures in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as the sole means of investment research. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. Okay? All right, so let's set an agenda for the day. And today, we have a limited amount of time. Let's talk about the usage of time and the impact of time in options trading. So I want to set up a quick example trade scenario where we're planning to place an option trade. But I really want to talk about how time can have an impact, how that impact might be measured, and how might it lead the trader to make certain conclusions about how they approach the structuring of an option trade. Lots to unpack there. So let's go right to Thinkorswim and set up an example trade scenario. So here we are on the Thinkorswim desktop trading software platform. And for today's example, we're going to be using Palantir Technologies. Okay, so have a quick glance at that chart. Let's say that our trader is just trying to gauge where they think the stock is likely to go. It's been generally moving higher, recent pullback, a pretty strong sell-off actually, highs stretching up to 125 recently, selling off a large percentage, down about 40% to lows recently, about $75. And now it's more recently been in recovery mode. Well, let me throw a few drawings on here that might be of interest to our traders. And that is, after this sell-off, it's interesting, we came right down to a possible upward sloping trend. Let's draw that in here. You can see we've been coming across lows recently, and when price comes down to those lows, it's had a tendency to rally. It doesn't mean that it's absolutely going to, but as we pulled back down from these extreme highs down to these recent lows, we've touched off that trend line, pushed up to recent resistance, and then just over the last 48 hours of trading or so, pushed up through that resistance. So for some traders, they would actually refer to this pattern where we have equal highs but rising lows. This might be seen as what's known as a symmetrical triangle. Now, I'm not going to go too far into technical analysis today. I want to spend the bulk of our time on options, But for some traders, they might see this as a scenario where maybe price is set to make another strong advance upward. Now, there are a couple of ways that a trader, as we've learned over the series of lessons that we just completed, there are a number of ways that a trader might pursue a bullish option strategy. And some of those can be constructed by buying options. Others can be constructed by selling options. All of them, though, have exposure to a time element. Yep, yeah, even an ascending triangle, exactly right. So let's go talk about the potential for the impact of time. Whether it's, when I say impact always sounds negative, sounds like you get hit by something, right? Well, actually, sometimes, did I say symmetrical? That's an ascending triangle. Like maybe I have symmetrical on the brain because we talked about a symmetrical triangle in a webcast yesterday. Yeah, it's an ascending triangle. If I said symmetrical, forgive me. I think I was just too enthusiastic to move on to the discussion of time decay. Anyway, but just know that the passage of time can be positive or negative. Sometimes it's fast, sometimes it's slow. It also is somewhat cyclical. Lots to cover here. So let's go put ourselves in the shoes of maybe a trader who's looking to buy a call option. So for Palantir Technologies, let's go out here to the 17th of April, just as an example. We're going to look at a contract with 23 days on it right now. And with the stock trading around, $95, how about we go to that $95 strike? It's actually a little bit closer to 96. You know what, for this, I'm actually going to go a little bit in the money on these contracts. So, and you'll see why. It's going to give a little bit deeper insight into time value of options versus intrinsic value of options. But let's go to let's actually go to the $94 strike in this case. And you can see that call option is trading between 705 and 720. I'm going to be a little bit generous. Actually, now it's at 710 and 720. Let's say we can buy this right now for 715. Obviously, until a trader places an order and assuming the order fills, until that moment, we don't know how much the contract is going to cost. But let's just say this is going to cost us 715. So we're going to buy conceptually. Let's bold this, by the way. By the 17th of April, $94 call, and that looks like about $7.15 at the moment. So what are we getting for our 715? Now, in our fifth lesson in our series of 10 lessons, we explored the vital role of the Greeks in options pricing, and it really is vital. And we're going to revisit some of that information today and then just go a little bit deeper. So if you happen to have missed that lessons, I had a series structured 10 lessons. We're not going with that structure forward from here, but if you want to go back to that series of lessons, make sure that you, first of all, have subscribed to our Trader Talks channel on YouTube. You can just go to YouTube, look for Trader Talks Schwab Coaching Webcast. That's going to be our home page here. You can subscribe to the channel just by clicking on the subscribe button down below the video stream right now, even without having to go track it down on YouTube. But on our home page here is where you can find our playlists of previous webcasts. So if I go to those playlists and I go looking for this webcast series, Getting Started with Options, well, you can actually just scroll down through, just keep your eyes open for Getting Started with Options. And actually, this series used to be taught by Barb Armstrong. So you're going to see her face on the series thumbnail. But right there, it says Getting Started with Options. So it's down and to the right, it's down close to the bottom of our list of webcast series. I'm going to click on View Full Playlists. But as we scroll down here, we can see lesson 10 of 10, 9 of 10, 8 of 10, 7 of 10. And going back to lesson 5, the vital role of options pricing and the Greeks. This is building up a little bit. Yeah, Eva says, oh, is this a changing of the class structure? It is, yeah. So I had a structured 10 lessons to sort of set the stage. And from here forward, we're sort of going to be putting into practice what we learned in those 10 lessons, and then just building on that, getting a little bit deeper into some of the concepts, that sort of thing. But we're not going to be labeling things with like lesson 13, lesson 19. Nope, stops at 10, okay? All right. Like last week, we just did Beginner's Guide to Understanding How Options Leverage Works. But let's go back to the Thinkorswim platform here and talk about what we just spent $715 on. So we spent $7.15 per share. And we know, if we have an understanding of call options, that for the next 23 days, if we spend that $7.15, we have the right to buy 100 shares of Palantir for $94 per share. So through the 17th of April, we now have the right to buy 100 shares of Palantir at any time, entirely at our discretion, for $94 per share. Well, you'll notice right now that, and look at how cooperative it's being. It's at exactly $96. The stock is at $96 right now. So if we have the right to buy shares for $94, and let's just note this, stock is at $96 at this moment. That's going to change. Well, that's giving us a $2 discount on the current price of the stock. So we just paid $7.15 for a $2 discount. Obviously, that's not what we're doing this for at this moment. It's what we would say is this contract right now has $2 of intrinsic value. Well, what the heck? Where did the rest of the $5.15 go? What is this $5.15 extra that we paid, since it's obviously not just for the discount on the shares? Well, it's for what we call, some will refer to this as the time value of the contract. The $5.15 is our time value, also known as the extrinsic value of the option. Ricebird, you like what I'm doing? Good. Yeah, set the stage, teach the basics, and then expand on it. That's the concept of this webcast series. Well, this element of options is vital. Over the course of the next 23 days, it's entirely possible, well, this is going to disappear. It's going to be impacted by the passage of time. So we really want to understand time decay. Now, this $5.15 is determined in a couple of ways. There are a couple of elements. Number one is that longer term options, we have to pay a higher premium for those. So a 23-day contract, so let's break this down. So we have our $5.15 intrinsic, or extrinsic, sorry, getting a little ahead of myself again, or also known as the time value of the contract. And that's actually broken down into two elements: the number of days plus the volatility of the stock. All right, so let's explore that for just a moment. I think it just makes sense. If we go out there and buy a contract that only has 3 days on it, and it gives us the right to buy shares at any time over the next 3 days for $94 per share, that's nice, but the stock doesn't have conceptually as much time it doesn't have as much time, literally, to make larger moves that might be beneficial to us as the owners of those contracts. So we pay less for less time on a contract. Just makes sense. But also, each of those days carries with it some inherent potential. How might we measure the potential of a given day? Is every day the same? Is every day the same on every stock? Nope. That actually comes down to how volatile is that stock. Because if we have two stocks out there, let's do a little comparison here. We have stock A and stock B. Stock A in a given day hardly does a thing. It moves up a few pennies, it moves down a few pennies. And if we have the right to buy shares locked in at $94 per share for the next 23 days on that stock, on stock A, who cares that it's 23 days? If the stock's hardly going to do anything, we're probably not going to be willing to pay very much for those 23 days as an extra on the discount that we already have. Okay? Now let's compare that to stock B. Stock B, we're buying a 23-day contract, but each day historically on stock B has been extremely volatile. Stock has moved up 10 bucks on Monday, down $10 on Tuesday. It goes for nice runs in one direction or the other. which one of those do you think is going to carry a greater premium above the discount that we're getting on the shares based on the potential for movement? Yeah, the volatility of stock B is going to cause that stock's time value to be greater. It just makes sense. Options buyers are willing to pay higher prices for more volatile stocks that carry greater potential. So the bottom line lesson here for our trader who is buying time is that time is not consistent from one stock, or the time value is not consistent from one stock's options to the next, nor is it consistent on the same stock's options from one time frame to the next. Because what if January tends to be a quiet month? What if October tends to be a highly volatile month? Well, you might have to pay more in January than we pay in October. But just be aware that that extrinsic value, that time value, can change from one stock to the next. So it shouldn't be surprising that when we look at one stock, we say, wow, wait a second, I'm getting a $2 discount on this one, and I'm only having to pay $1 for time. On another stock, maybe I'm having to pay $5 for 23 days worth of time. Yep. I can make sense of this with Palantir. I can just look at how much this thing moves. Does it make sense if we look at the last 23 days on this thing and we project forward to the next 23 days? Wow, if we got a move like this, but in a bullish direction, how much potential is there for profit? Quite a bit. So yeah, that 515 of extrinsic value is a combination of the number of days, so literal time, and volatility. All right, so let's focus on the days first. So if there are two primary elements, there's a third that we discussed in lesson 5. It's known as rho. It's a measurement of the impact of interest rates. It's just so nominal that for most traders, it's sort of academic. It's not really largely a tradable event. It just has such a little impact that I'm going to leave it out of this discussion. If you want to go see rho, go watch that lesson 5 again. But for practical purposes, not terribly tradable, the impact of rho. All right, but first thing that a trader might want to do is understand this number of days element with time. And I'm going to go to the trade tab and talk about the implications of the number of days for buyers versus sellers. Okay, looking at this from the buyer's perspective, first of all, actually, maybe what we'll do is talk about how time is actually impacted by the passage, or the number of days, obviously, impacted by the passage of time. So each day that ticks away reduces the value of our contract. So you might think, okay, so if we were to buy a contract with 23 days, I think this is a logical thing. I thought this was the way it would work. Well, I'd just get out my calculator. I'm going to take $5.15. If that's what we're paying for 23 days, let's just divide that by 23. And it must mean that each day that goes by, we would lose 22 cents of the value that we paid for those days. Doesn't that make sense? However, that's not actually the way it works. This that we just calculated theoretically is what we would call the theta of this trade. So theta is the impact of time. Theta starts with T, so does time. It's the impact of time passage on the value of this option that we're trading. So my working theory, my working premise here is that over the next 24 hours, if time just has a linear impact on the value of our option, we should lose about 22 cents. But if I were to look at the actual theta on these contracts, let's look at this theta column. Now, if you're not seeing theta as one of the columns on your option chain, you can just go right up here, just to the right of where it says spread single. These are your column headings that we've selected. And just choose the Greeks right there, delta, gamma, theta, vega. But as I look at my theta, it's not 22 cents. It's actually, as we look at the 94, it's 14 cents. What this is literally telling me is that over the next 24 hours, if nothing else changes, if the price doesn't move, if expectations for volatility don't change, the trader might expect to lose 14 cents on the value of their contract, not 22 cents. So it's slower than expected. Well, that's because time decay actually accelerates as we get closer to expiration. Let's look at that same number. Let me see. I don't even know if this is going to exist. I didn't check. Yeah, there it is. Okay. Just had to make sure that we had a $94 strike price for the 3-day contracts. But if I look at that $94 contract with 3 days left, and I look at that theta column, this is now telling us, Cameron, we're going to lose 40 cents of value over the passage, over the course of 24 hours from this contract. So here's the take-home lesson. Options do not lose value at a fixed rate of speed from the time we take the trade until the time hits expiration. Instead, the time decay starts off relatively slowly, and then it accelerates toward expiration. So Jim says, is time on a logarithmic curve? Not quite, Jim, because if it were operating all by itself, it would be. Yeah, but it's not operating in isolation. That also there's an element of volatility. But just looking at the fact that assuming everything else holds constant, yes, there's this logarithmic acceleration toward expiration, which basically just means you're going to, the impact of time decay is going to be faster and faster and faster as we get closer to expiration. Here are the adjustments that a buyer might make and that a seller might make in reaction to that. For a buyer, that time decay is chipping away at the value of their contract. Don't like that. So for what some buyers will do in response is they will try to stay away from expiration. Let's suppose that we had a trade. Let's go back to our chart here. And let's assume that maybe the stock has been within this triangle for about a month. And maybe they think on breaking out of this, it might run up for a month. And I'm just going to eyeball this. Let's say we think we're going to run up to $110 over the course of the next month. Well, that trader, if they're planning on buying a call, somebody might say, well, if we think the stock's going to go up for a month, wouldn't we buy a contract with a month on the contract? So we're minimizing the cost of the contract? Well, that's possible. The problem is we have time decay working against us the whole time. And if we allow the contract to run right up to expiration, that time decay, it's like swimming against an aggressive river. That can make it hard to trade those contracts profitably. So instead, what the trader might do to try to slow down the negative impact of time decay is to double the length of the contract that they buy. If they need a month, maybe they buy a contract with 2 months on it with the plan to get in and out of that contract while there's still a month left, and they're avoiding the fastest portion of the time decay. Yeah. George, yeah, it's an exponential decay pattern rather than a straight line. That's right. Yep. So that's the implication for a call buyer. Now, not everybody's going to use that rule of thumb where they're doubling the amount of time that they buy. Some may buy more because they're willing to spend a little more money to try to minimize that time. Let's see how much we'd be minimizing that time decay. If instead of buying, let's say, a 23-day contract, let's go out here, even beyond 52, let's go to an 87-day contract, the 20th of June. And let's say we were just going to buy a call with a 20th of June expiration. We're going to wait for a month, sell it at the end of the month. Well, over the next 24 hours, if we look at our theta, our time decay, it's not 40 cents like we were seeing on the 3-day contract. It's not, 14 cents like we were seeing on the 23-day contract. It's only 8 cents of time decay. You can see how slow, faster, yeah, accelerating toward that expiration. So, and by the way, the 95, whether we're at 90 or 95, they're both about 8 cents in this case. So we were looking at the 94, 95 is as close as we can get to a fair comparison. So understanding time may cause a call buyer, an options buyer, to adjust their approach and try to stay away from that expiration. That's if we're a buyer. What if we're a seller? Sellers may try to take advantage of that faster time decay. Yeah, sellers are quite likely, not always, this is not going to be always universally the case, but they may try to sell closer to expiration. Now, when we move closer to expiration, what that's naturally going to do is it's going to deliver a smaller premium, so there's a trade-off for our seller, but on a day-to-day basis, that time decay that's chipping away at the value for the options buyer could be contributing to the profits of the options seller. Janelle, so you're learning, is this helping out? That's great. All right, and I think you're having a little sidebar discussion there with Eva, so thank you to everyone for having, I think those little extra discussions in the chat can be really beneficial. But yeah, our sellers might actually try to push the trade closer to expiration, optimizing, maximizing that time decay. So that's sort of lesson one, is that number of days, the passage of time is not a linear impact, and that's measurable using theta. Now, a second big takeaway is that even that decay element, it's not a perfectly linear curve toward expiration. Instead, there's actually little bumps in acceleration of time decay. There are times when the clock speeds up as we're moving toward expiration, and there are other times when it slows down. So what we now need to do is bring in that volatility element, because yes, if the number of days just worked all by themselves in isolation, there would be this nifty, neat little linear learning, not linear, but exponential curve toward expiration. But volatility still plays a very strong role. So I want to shift up our discussion here of time decay, and I want to bring in volatility using the VIX. So what is the VIX? Well, for stock traders, they'll commonly use an index to get a gauge on the general pricing of stocks. Like they might look at the S&P 500. And if the S&P is going up, there's a strong probability that most individual stocks are going up as well. It's not always the case, not true to every single stock. But yeah, if the S&P is persistently going higher, and let's say that our would-be stock trader is persistently trying to do bearish trades, they're probably, again, swimming upstream to some extent. Well, to the same extent that stock traders will look to an index, options traders will also commonly look to an index to check the general pricing of options. So let's talk about the VIX, or the CBOE Market Volatility Index, and its implications for options traders. So this looks very similar to a chart of like an S&P, the S&P or the NASDAQ or the Dow, whatever stock index a trader might be looking at. But instead, this is a general gauge of the volatility of the S&P, and specifically, it's a chart of the expected volatility for the S&P over the next 30 days based on the pricing of options for the S&P. That's a bit of a mouthful. But yeah, if we were to look at the peaks and valleys on this chart, let me give you maybe a more direct interpretation of this. When this chart is high, it implies that volatility expectations are also high over the next 30 days for the S&P. When this chart is low, volatility expectations over the next 30 days are low. Now, that has a direct impact on options pricing. When volatility expectations are high, that can get options buyers excited. Now, it might excite them for a couple of reasons. It might excite them if they're speculators. When volatility is high, a speculator might say, ooh, I could buy a call and make a lot of money, or I could buy a put and make a lot of money, depending on which direction that volatility ultimately chooses. But yeah, high expectations for volatility can drive up demand from speculators. It can also drive up demand from hedgers who see high volatility as danger. Hedgers sometimes use options to hedge the risk in portfolios. And so At the same time, there might be more speculation in options. There could also be a lot of hedging driving up buying of options. But in any case, when we see volatility high, that will tend to drive up the pricing of options. And specifically, it drives up the extrinsic value of options. So this is important. So as a result of that function, as a result of that assumption, what traders will sometimes describe this chart as a fear gauge that can have implications for whether it's a buyer's market or a seller's market for options. If volatility expectations are high and prices are high, Janelle says, so would this be considered another form of technical analysis? It is, Janelle, to some extent. Yeah, I will say that traditional but really over time it goes sideways. But for our options trader out there, what they might do as a bottom line is just look to see, well, is it higher right now and starting to fall? Or is it lower right now and starting to rise? Because if it's high, the implication for most options out there is that prices are high. And do buyers like to buy at high prices, or do sellers like to sell at high prices? Yeah. When this chart is high, that's generally described as being a seller's market for options. Volatility's at a peak, or seems to be peaking. And when prices are high, whether we're selling houses or we're selling cars or we're selling options, that's when traders prefer to sell. As those prices drop, if we sold a contract up where we're hoping that prices will go down so we can buy it back less expensively, that can help out that trade if prices are generally falling. Yeah, high and falling VIX. Bottom line, whether you follow the logic of the VIX or not, a high and falling VIX is generally described as a seller's market for options. A low and rising VIX means that options prices are probably low. If we're out there trying to buy, we're probably buying relatively inexpensively. And as the volatility picks up, that can drive up that extrinsic value of options and give a boost to the options trader, to the options buyer. Now, this happens to be kind of an interesting moment in history where we find ourselves at this moment. So if we look at where the volatility chart is right now, we look back over the last 12 months, it's actually been higher a good chunk of the time. It's been lower a good chunk of the time. This is sort of a balance point. So there may not be a bias for some traders, whether they're buying or selling options. Could be a good market for buying if volatility starts to rise from here. Could be a good market for selling if volatility continues to drop, right? And we can even look at this on a longer term time frame. If I go to a 10-year chart, you can see here we are right now. There have certainly been times when volatility has been higher. There have certainly been good stretches of time when volatility has been lower than it is right now. Okay? But this combination of number of days on a contract and the positioning of the volatility chart may start to inform a trader more precisely with whether they choose to buy or sell, and whether they tend to go further out in time or closer to expiration. So that's pretty important. Okay. Now, this concept of volatility rising and falling, this is just an index. With a stock trader, they might look at the S&P 500 and say, oh, the S&P is going up, and therefore probably most stocks are going up as well. But before they buy a stock themselves, they might decide to go look at the chart of the stock, if a trader uses technical analysis in the planning of stock trades, obviously. But yeah, they might not just say, well, yeah, the S&P is going up, so I'm going to go buy some random stock. Well, maybe they check the individual stock chart. To the same extent, an options trader may look at a different chart to see how the options on that stock are being priced at the moment. Let's just say that with our VIX observer right now, let's say they've seen prices have been high and have been falling. Maybe they expect this to continue to fall down to levels that we've seen earlier in the year. So let's just suppose here, Janelle, we do some basic technical analysis and we think maybe we're likely to head down further. That would still be a continuation of a seller's market. That's still driving prices down. So if we sell now and prices continue to go down, that can help a trade. Well, it's possible that our stocks options aren't actually dropping in value. Let me go back to Palantir. Here's Palantir. And I want to bring up a volatility chart, not for the stock market, but for this stock specifically. And there's actually a tool that we can use. It's right here under our studies icon. It's called implied volatility. Implied means sort of expected volatility. So in this case, it's not going to be expected volatility for the S&P 500, but expected volatility for Palantir. So I'm going to click on apply and then click OK. And then we're left with this green line down here, quite like the VIX, except the VIX is measuring rising and falling prices of options generally, like an index. This is measuring rising and falling options prices on Palantir's options. So I want you to look at this. Sometimes Palantir's options are relatively expensive compared to other times. At other times, Palantir's options are relatively inexpensive. And there's sort of an ebb and flow to this. It's actually, to a large extent, more predictable than what we see on the VIX. With individual stocks, very commonly, not every single stock, but quite commonly, we'll see a cyclical ebb and flow in the pricing of options. And it is tied to what event? Each quarter. Earnings. Yep. Moxie, NYC. You see that? Janelle says there's so many tools to use. Yeah, not every trader needs to use every tool out there, but I wanted to take a deeper look at how time value works. So that's what we're doing today. So this might be one of those webcasts where you have to sort of put a pin in it and go back and watch it a couple of times if some of these are new tools to you. But I would suspect for some of our more veteran options traders here, I haven't done anything new for a lot of them. I know who I'm talking to. I know some of you have been around for a while. Yeah, some of them are going to know exactly what the VIX is. They're going to know exactly what implied volatility is. They're going to know exactly the impact on time value of the contract. But just look at this green line as when it's low, options prices on Palantir probably lower than at other times. If it's rising, those options prices are probably generally going up. Now, it's possible that if it's taking a while to go up, the passage of time on the number of contracts is kind of dragging prices down. But what this can effectively do is slow down how much time decay we're seeing. Janelle, you say you pin all the videos? Well, good. Yeah. But for some traders, they may look, let's say we're looking to buy a call option or a put option, works the same way. They may first check the VIX. Let's see what the general pricing of options is out there. If VIX low and starting to rise, okay, it's kind of a buyer's market for options. And then they might go and look at this implied volatility chart. And if it is also low and rising, maybe it's a buyer's market for the individual stocks options as well. All right. So why is there such a pronounced pattern to this around earnings? Well, I think it's always helpful to put ourselves in the shoes of an options buyer in advance of an earnings. As we get closer and closer and closer to that earnings announcement, traders are aware earnings can deliver a lot of volatility. And so for the speculators, they might say, ooh, there's opportunity there. If I buy a call option in advance of this earnings and the earnings goes really well, I can make a lot of money. Or if I buy a put in advance of this earnings and there's a really negative announcement, I could make a lot of money. So speculators can drive demand up on Palantir's options in advance of earnings. But at the same time, there are those that just see risk in that earnings announcement. And they may look to Palantir's options to try to mitigate that risk through a number of different strategies. And they can drive up demand for options. But yeah, there tends to be this cyclical behavior around many stocks options, not every stock. But yeah, in advance of earnings, there will be increasing demand. recognizing increasing probability of volatility, which can drive up that intrinsic, that extrinsic value of the contract. But right after the earnings, the speculators have their answer. The hedgers, the risk is in the rearview mirror, and there can be a lot of exiting of options, a decrease in demand sharply after an earnings announcement. And so we get a big drop in the value of options right after earnings. And that's known as what, John? The volatility crush. Yep. Yeah. But does that mean maybe our trader just wants to buy in to a long call and get out before that earnings announcement? Is that an adjustment that could be made if they want to take advantage of that rising volatility, the slowing down of time decay on the contract? Maybe just using this, hopefully, to some advantage there, but avoiding the earnings crush. Yeah, there are a number of potential implications for buyers and for sellers. For our buyers, maybe they buy as earnings as volatility is rising. For our sellers, maybe selling when volatility has already risen and is starting to fall. Now, even though we can get a sharp sell-off right after an earnings, does that mean that we always have to sell right before the earnings and sit through the big unknown of an earnings announcement? No, maybe the trader waits till the day or the week after, and they get to see an acceleration of time decay for a period. Right? Okay. But guys, I know that this has been a lot, but I wanted to take a closer look at this element of time. It actually is, at least in my estimation, I don't know whether a stock's price is always going to go up or down. I don't know if volatility is necessarily going to rise or fall. But the one thing I do know is that tomorrow's coming. The passage of time is the most predictable element of an options trade. And so therefore, for some traders, they may want to really understand how time works. And when I'm talking about time, it's not just the number of days, it's the full extrinsic time value of that option contract. And there can be adjustments made. Buying more time or selling less time. Buying at lower levels on implied volatility or the volatility index, selling at higher levels on implied volatility or the volatility index. Yep, some important potential implications. In any case, even if we thoroughly understand this stuff, is it ever a guarantee that a trade is going to work out? Nope. There's plenty that can come along and still put a drag on the performance of a trade. But where there is opportunity to try to improve performance, does a trader have motivation to pursue that to whatever extent possible? Yeah. Stephen says, you better understand theta or you're going to cook your trade. Stephen, yeah, theta it's an understated element of options, but we really want to understand that, right? Okay, guys, time for me to let you go. I hope you've enjoyed this discussion. This is what we do in this webcast series. We go at a pace, hopefully, that everybody can follow. This one maybe a little bit faster than typical discussions. This is one that maybe some of you might want to go back and revisit on the archive after the fact, but it is an essential element of understanding how to trade options. So John says, to summarize, an option seller can still participate with a volatility crush by selling the morning after earnings. I can't tell you specific timing like that, John, and also not every stock's options behave in exactly the same way, but just understanding the general ebb and flow. Conceptually, the trader might be using that to help the planning of options timing. Yep. Okay. All right, everybody. Thanks for giving me your time today. I hope that I'll see you in my webcast again next Tuesday. We meet each Tuesday at noon Eastern. I'd love to have you here. But I have other webcasts scheduled throughout the week, and we have a whole range of other webcasts taught by other instructors. So do yourself a favor and make sure that if you haven't subscribed to our Trader Talk channel, do that right now. You can go down and click on the subscribe button. It only takes a second, and it doesn't cost anything. But our Trader Talks Schwab Coaching Webcast YouTube channel is where we house our completed playlists, and you can join the live streams right here. Also, make sure that you're following Kevin and me on X. You can find Kevin at Kevin Horner CS. You can find me there at Cameron May CS, but X is the best place to connect with your favorite presenters. So give us a follow there. That doesn't cost anything as well. And thank you to everybody who has already clicked the like button. It looks like we have a couple hundred people watching right now. 77 people have already clicked the like button. That's awesome. That really feels good. Thank you for doing that. It sounds like applause to me when you click that like button, and it gives my webcast a boost in the YouTube algorithm, helps more people find it and learn about essential things in options trading, like understanding time decay. It's not just the clock turning, and it's not just, well, it's important to see it from the perspective of a buyer and a seller. All right, I will see you all in a week. I'll also look for you on X. Thanks, Kevin, for helping out in chat. Guys, whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.